Greetings, Series 7 test takers. This is the Series 7 guru coming to you from my studio here in fabulous Las Vegas. Very excited with this latest content. This is a Series 7 exam prep options practice test. One of the things people tell me they like most about the channel is practice questions. And so here we go with another long form. I'm going to set my timer for 30 minutes, so we'll know when we've hit a 30-minute. Most people aren't wired for more than 30, 45 minutes an hour. So, as I always say, inch by inch options are a cinch, yard by yard options are hard. So when the 30 minutes beeps, you can take a break. I would take this in bite-sized chunks. Second thing is I wouldn't be attempting to do practice exams and practice tests, particularly in options, till you've laid enough base knowledge. So what you should be doing is hitting pause, trying to answer, and then hit play and see if you got it right. Now, when you hit pause, if on the first couple of questions you're struggling to figure out what's being asked and what are the answers being offered to you, I highly recommend that you circle back. And in the options playlist, we have over 20 hours of options, but the first 3 videos are very, very important. So I highly recommend you watch those first 3 videos in the options playlist before you attempt this option practice test. So that's my warning to you. Good news, it's videos, so you can hit pause, you can go watch the lectures and come back and attempt it again. All right, so let's get started. Again, this isn't lecture, so I'm going to be moving pretty quick because I do want to bring this in some reasonable time frame. In our channel, we're unique in terms of my channel, in terms of doing long form content. So, that's good and it's bad. The advantage, you get a lot of stuff in one video, but to get this through this in some kind of reasonable, usually these come in like at 90 minutes or somewhere in that neighborhood. To get that done, we're going to go quick. So my idea here is not just plain options to you or lecture, it's to give you practice questions and do some explications. That's just a fancy word for saying explanations for that. All right, so let's get started. A customer buys one BFD, December 140 put at 7. So the first thing I would do as a test taker is say, okay, what I'm looking at is a choice to sell the stock at 140. So you want to get good at contract specifications. When BFD is trading at 141, it doesn't matter where BFD is trading at when we do the trade. It matters where it's at several weeks later when we close out at intrinsic value or at expiration. That's when it matters. Now, the exception to that would be is if we're actually taking a stock position at 141. We're not here. So 141 has nothing to do with answering this question. At expiration, BFD is 126, and we close the position. So you should know that one of 3 things can happen to that put contract. That put contract may be traded, that put contract can be exercised, or that put contract can expire worthless. Well, the 140 put with the stock at 126 is not going to expire worthless. I'm going to choose to exercise that. Now, you could have just simply memorized breakevens and said, well, my breakeven is 133 and the stock's at 126. That's 7 points in the right direction. I made 7 points. But what I want you to try and get comfortable with is a T tracking money in and out. And so I did an opening purchase at 7 for the option position. And when the stock is 126, I'm going to buy the stock at 126. I'm going to exercise my put at 140. And this is just another way of saying that I'm going to make 7 points. So I have a $700 gain. A customer buys 100 shares. Now, the minute I see 100 shares, I got to be focused on the stock. I can't tell you how many people get hung up when they have a stock position plus options. The stock always dominates. So it's really important to know that when I buy the stock at 141, I'm bullish. And so then we're going to do our initial setup. So we paid 141 for the stock. We sell a BFD January 145 call at 3. So I'm obligating myself to sell the stock at 145. And for that, I collected 3 points in. And then I established a choice to sell the stock at 135. Kind of interesting. I have both a covered call and a protective put. I have a covered call. I'm green to sell stock I own, an obligation to sell the stock I own, and I have a choice to sell the stock I own. This is called a caller. A caller is when you're long the stock and you sell a call to fund the purchase for the put. This is called a cashless caller. Cashless because I'm not having to pay for the put. I'm funding the purchase of the put by selling the call. Again, I wouldn't worry too much about this is a caller. I'd be able to track the money. So what is my maximum gain? Well, one thing you should know is that when you obligate yourself to sell the stock, you don't participate past the strike price. You don't participate past the strike price. So the most I can make here, and I'm just going to net this, is 144, 148, $400. I don't participate past the strike price. Please note the slides are numbered in the bottom right. This is question number 3. So you can either tell me, Dean, question 3, or you can use Dean in the video at time whatever, at 2 minutes in or 2:05 if you have questions. I will timestamp this lecture. It's timestamps all the lectures. So please do check out the timestamps. You don't have to watch the entire thing to find practice problems that you're looking for. You can just go through them through the timestamp and also read the comments. There's a lot of testable content when people ask questions and I respond. All right, so we buy one BFD, a December 140 call at 7, and we buy a BFD December 140 put at 7. So we have a choice to buy the stock at 140 and a choice to sell the stock at 140. I would definitely be able to identify this as a straddle. And what we're straddling is the strike price. The strike price here is 140. You know, the second thing we got to be able to do on a straddle is calculate the breakevens. Breakevens. This is the only strategy on Series 7 in which you have 2 breakevens. And the way I'm going to do that is I'm going to take the strike price plus total premium to get my upside breakeven. So in this case, that's going to be 140 plus 14. Upside breakeven. By the way, I've been doing some major updates in my studio here in Las Vegas, and I've actually bought another kind of a screen, a big tablet screen. So I'm so excited I won't have to be writing, you know, vertically. I'll be able to write horizontal. So anyways, excited about that. So 140 plus 14 means my upside break even is 154. By the way, I only have one answer that has that in it. So as a test taker, I said, well, that looks like yeah, but you know, just to verify it, 140 minus 14 is indeed 126. That's my downside break even. You know, again, this isn't a lecture. I would refer you to my lecture called Score 4 More with Straddles. You know, again, where I go through straddles and advanced option strategies where I do this as well. Please note the third thing is where is it profitable? And if it's a long straddle, we want the stock to be above 154 or below 126. And then when we use it, we use a straddle when we're expecting volatility. Buy one BFD, 140 call. It looks like the same straddle to me. Buy 140 put. Now, one of the common themes that runs throughout options is if you buy option positions, option contracts, the worst case is that they expire worthless. So if at expiration, BFD is 140, both the call, both the put will expire, and I'm gonna lose $1,400, right? So if I bought just that call, I could lose 700. If I bought the put, I could lose 700, but now I'm out of pocket 14 points or $1,400, and that is my max loss. So when you buy options, the worst case is contract, or in this case, contracts expire worthless and you lose money. So very easy to qualify somebody here. Can this $1,400 you can afford to lose? It looks like the same straddle. I tried to mix up these slides after I wrote the questions, but a little more sequential than you could expect on your test. So here's our strike price. We're straddling strike price of 140. Here is the market price. There's our upside and our downside break even of 154 and 126. And so what we want, let me get a different color here, is we want it to be above 154 or below 126. And how far above can it be? It has unlimited gain potential. Unlimited gain potential. Well, every strategy has its opposite. So if we have long straddles, we have short straddles. So a straddle is when you're long two different type of option contracts or short two different type of option contracts. So this is test question, a short straddle. We've got to be able to identify it. And so if we go back to what we just did, this is the opposite position. So we would want this to be in between these two numbers. And if we're wrong, please note, we've got a naked call there, right? So if we're wrong, the stock goes above 154 and we have unlimited loss potential. Don't overthink this on the test. Like, well, the put that, in total, a short straddle has unlimited loss potential. You certainly get tested on recognizing things that expose customers to unlimited risk. A short straddle is one of them. A short call is another. A short the stock is another, right? So make sure you got that. Oh, maximum gain. Well, again, it's the opposite. If we brought in 14 points, there's 7 and 7. We brought in 14. And what we want when we sell option contract, or in this case, contracts, is we want the contract or contracts to expire. So we get to go neener, neener, neener. Another common theme in options. Anytime I collect money, the best case is contract or contracts expire, and I get to keep the money. A customer buys a September 50 call at 3 and buys a BFD a 50 put at 2. This is profitable if BFD at expiration. So again, what we're looking at here is a long straddle. And so our upside break even is going to be 55 strike price plus total premium. Our downside break even is going to be 45 strike price less total premium. And a good mnemonic for straddle profitability is SILO. And that stands for short inside, long outside. Here we're long the straddle, so we want it to be above 55 or below 45 to be profitable. Above 45, 55, or below 45 at expiration. A customer buys one Apple August 140 call and buys 140 put at 7. So again, it looks like I got a duplicate here based on Apple. We've done this one. Well, too late to delete the slide, but this is the same one we've been working on. So 140 plus a 14, 154 is my upside break even, and we set our downside break even as 126. A customer buys a May 50 call and buys a May 45 put. So this looks like a straddle. Looks like a long straddle, but a straddle with different strike prices, is known as a combination. So a straddle with different strike prices is a combination. We wouldn't do anything differently here, by the way. We would total the premiums, add it to the 50 call to get our upside break even, subtract it from the 45 put to get our downside break even, SILO, short inside, long outside, whatever those two numbers are, we want the market price of the stock to be either above the upside break even or below the downside break even. Which of the following is a real-time index representing the market's expected expectations for volatility over the next 30 days that is certainly testable? And that is the VIX. The OEX is the S&P 100, the SPX is the 500, and beta is just a distractor. It's a wrong answer. I've recommended that when you're going through my content on my channel, what I might recommend is having like a 4x6 cards. And on questions like this that I just think are great poor man's flashcards, what I mean by that is, it's a recognition question. Maybe just make a flashcard and do that. No, I'm not going to sell you the videos. Tell me what you think here, by the way. I have the ability to merchandise the channel. And as part of that, if I chose to do it, I'm trying to make everything free, and I don't want to create a mess for myself. But that being said, I get requests all the time, even though I tell you, no, I'm not sending you the PDFs you see on the file. I'm not sending you slide decks. But I could, in theory, add, a button that you could hit and you could buy the deck, or you could buy the practice final, whatever the case is. Let me know your thoughts on that. I'd rather you do the work and me, I'm already doing a lot of work for free, but let me know what you think about monetizing the channel in that way. Hey, anyways, until I do that, the answer is you're gonna have to make your own flashcards as you go through the content. Anyways, a customer buys a BFD December 140 put at 7 when BFD is trading at 141. Was again, we said it doesn't matter. It doesn't matter where BFD is at when we do the trade. It matters when they say several weeks later or at expiration. Now, we encountered intellectually this same question earlier where we had expiration. As you recall, when we had that question at expiration, we no longer can trade the option, so it got exercised. At some point, I'm not under any obligation to tell you what happened to the option contract at expiration. As a test taker, you should know that if at expiration the contract has intrinsic value, it will be exercised. As a test taker, you should know at expiration, if the contract has no intrinsic value, it will expire worthless. Now here we're saying several weeks later, and that's one of the things I like to do as well. So again, I'm going to make my T and I'm going to track money. And really important, we're doing here an opening purchase. We're doing an opening purchase at 7. And remember, to offset the opening purchase, we're going to do a closing sale. So that's my dollars out. That's my dollars in. Now, again, you could just memorize that my break even is 133, 126 is 7 points in the right direction. You can do that. But I find a lot of times when people are memorizing break evens, then they get bogged down in the phraseology. And so now it says with the stock at 126, I close out at intrinsic value. So the intrinsic value of a 140 put with a stock at 140 is 14 points. Wow, pretty cool. I did my opening purchase at 7. I did my closing sale at 14. I doubled my money. One reason people buy options is they provide you with a significant amount of leverage, making a little money do a lot. Now, I would warn you, the same supercharged speed you make money with is the same supercharged speed you're going to lose money with. And P.S., this is a very smart bear, because if you're wrong, you just lose your premium, right? There are other ways to be a bear, but you could be a smart bear like we are here, or a dumb bear. If the stock is 140 or higher, I just lose my premium. That wouldn't be the case if I were short the stock or short the call or did some other foolish thing. All the following are true of the VIX option contract. So VIX, as we saw in an earlier question, measures volatility. And the volatility, implied volatility in the market is based on the calls versus puts. When people are nervous, they're willing to pay more for puts than call contracts. And we can do some math and come up with what's called implied volatility. So VIX option contracts can profit from an increase or decrease in the volatility of the S&P 500. That's very much the whole point of a VIX option contract. So that is true. We're looking for something that is false. To hedge a drop in the S&P 500, an investor might buy a VIX call option. Yeah, because there's negative correlation. Not always, but most of the time. And for test purposes, always. If I think volatility is going up, as I just mentioned, it's because the market is going down based on the implied volatility of the puts versus the calls. So that is true. The idea here is as the market goes down, my portfolio goes down, my VIX call contract goes up in value. So that's true. A long VIX call contract might be used by an investor who is bearish. Yeah, this is another one of those weird ones where actually a long VIX call becomes more profitable if the market drops because of negative correlation. That's true. Now, as a test taker, you should know that C and D are kind of exclusive. You got to pick one or the other. A VIX put contract might be used by an investor who's bearish. No, it's a put contract. You expect it to go the opposite direction, right? So that is false. If you are bearish on the S&P 500, as we just said, you would buy a VIX call. So the answer there is D. The takeaway is to know that it has negative correlation. What is the most suitable recommendation for a speculator who expects a big price move but is uncertain whether it'll be up or down? That's very much a test question about when do we use a straddle? When do we use a straddle? That's a long straddle. So we use a long straddle. By the way, please note this question says suitable. Suitability is a big part of the exam, and suitability is based on the products, the investment vehicles, and knowing, when those investment vehicles or products or strategy are indeed suitable, right? So this is a twofer, basically. It's a suitability question, but it's also about a long straddle. A customer has a bond portfolio. What would be the best hedge? So, yield-based options have a direct relationship with interest rates. So you spend all this time learning about the inverse relationship, but yield-based options have a direct relationship. So what I mean by that is if we think interest rates are going up, we would buy a yield-based call. And if we thought interest rates are going down, we'd sell a yield-based call. If we thought interest rates were going down, we'd buy a yield-based put. That's, by the way, what I'm drawing there is the matrix. If you're not using, Dean's method of, doing options, maybe that makes no sense to you. Okay, so now we got to go back to what am I worried about if I own a bond portfolio? I should definitely know that if I own a bond portfolio, what I'm concerned about is interest rates going up, causing my bonds to go down. And so what I would do is I buy a yield-based call. And I would hope the value of my yield-based call contract rises, remember, because it has a direct relationship with interest rates, as my bond portfolio goes down. So the answer is A. A customer shorts one BFD December 140 call at 7 when BFD is at 141. Again, it does not matter. Doesn't matter where BFD is at when we do the trade. Several weeks later, the stock's at 154, and I close out at intrinsic value. Now, I could have just memorized the break even and said break even is strike price plus premium 147. 154 is 7 points in the wrong direction. You could do that, but I'm trying to get you comfortable with setting up T's and marking closing out positions. So here we did an opening sale at 7, and so that's money in. So the offset is going to be doing a closing purchase. So we did an opening sale. That's how we created this short position at 7, and now it's a 140 call, and the stock is 154. That means we're going to do that for 14. We're going to do our closing purchase. And please note, that's not going to work. That means we have a $700 loss. By the way, you should definitely recognize that it has unlimited loss potential. That has unlimited loss potential. A customer buys 100 shares of BFD. Now, we do care. We definitely care now. It's not trading at 143. It was 143 when we bought the stock. And the stock position dominates. So this is a bullish stock position. You can't let the option tail wag the stock dog. And so you can either memorize break evens, or you can get good at a T. I paid 143 for the stock. I paid 4 points for my choice to sell. This is a protective put. And so my break even is 147. Stock cost plus premium. Please note, this is the one time and the one time only that it's a put, and we're actually adding. I can't believe how many people get hung up on this. So you can't be focused on that. You can't let the tail wag the dog. And the dog here is the stock. You got to stay focused on the stock. So that's called a protective put. So I own the stock at 143. I paid 4 points for the protection. So I'm out of pocket. 147. Anytime I want, I can stick it to somebody at 140. So I do this to be able to participate in a big price increase, but not participate in a big price decline. Which of the following short options positions, if exercised, would result in the delivery of the underlying? So if I'm short and I have to deliver the underlying as the stock, that's going to be a short call. So I'm going to need the stock. So the margin clerk is going to say, Dean, where's the stock? Now, if it's in my account already, that's fine, right? That's a covered call. If it's not on my account, I'm going to have to go in the open market and buy that. So again, that's the reality at expiration, right? If this short option position, it's a call contract. And if at expiration, the contract has intrinsic value, the contract will be exercised, which means the stock is going to be called away from me at the strike price. And that means I need the stock. By the way, I would know what you need for each of those. A customer shorts 100 shares of BFD at 143. Now we care. We care, right? Whenever we see that stock, we got to say, whoa, this is a stock position. Stock position dominates, regardless of what comes next. This is a bearish stock position, because when you're short the stock, you are bear. Now, as we said, this is a smart bear, because this bear knows that if all they do is sell that stock short at 143, they're going to have an unlimited risk. And so this smart bear says, you know what I'm going to do? I think I'm going to establish the choice to buy back the borrowed stock at a set price. Options are all about floors and ceilings. And so I'm going to buy some protection. This is called a protective call. Now, again, you got to be real careful here that you don't get focused on this part of the transaction. Because if that's what you think it is, you're going to tell me the break-even is 149, you're bullish, your max loss is $400, your max gains on limit. No, 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 no. The stock dominates. So as you see here, I'm out 140. I brought in 143 for the short stock. I paid 4 points for the protection. And this is why this is so bueno here, because now the worst case is I can buy back the stock at 145. Now here I asked you the maximum loss. And so it looks like my answer set, that happens when I, spend hours writing these things. Sometimes I don't proof it as much as I should before I put it up there. Anyways, the loss here is going to be maximum loss is 143, 149. The loss is $600, 6 points or $600. So boom. Let me make a note to myself. So when I'm doing the timestamps, I can make a note and say slide number 20 has an answer set for this. I'm not going to redo question 20. I'm just going to leave it as is. I'm sure that what I did is hit duplicate, enter, and trying to answer different things about the same thing. So let's see if I redeem myself. By the way, the break even is 139. I bet you we're going to bump into a question where that answer set will be appropriate. What is the maximum loss? Well, we just did that. Looks like I got a duplicate. Well, now we find my mistake there. So let's see. If I short the stock at 143, oh, no, no, no. Be careful here. Here I bought a call, smart bear, right? And here I sold a put, dumb bear. Not very smart. So here, oh, there's my break even, by the way. Right. So my break even was I think I showed this one to you. So let's see. I was on slide 20 was where we had the mistake. You should definitely know this is an ineffective hedge, because here I haven't effectively hedged the short stock position. And as you see here, let's just make our T. I brought in 143 for the stock, and then I brought another 4 points in for the put. So my break even is 147. But the problem is I haven't effectively hedged the short stock position. I don't want to have an obligation to buy back the borrowed stock. I want to have a choice. So that's not effectively hedged. In the business, we call that a partial hedge. It kind of works. I mean, I get 4 points of price appreciation, price protection, but I'm still hanging in the wind, because if it's 135 or higher, the put expires, and I'm still got this obligation to go in the open market and buy the stock. So you should definitely recognize that short the stock and short a put still exposes you to unlimited risk. Now, again, you're not focused on the put here. The put, if you think that's just a put, you're gonna tell me the break even is 131. The max gain is 400. The max loss is break even to 0. No, 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 no. The stock position dominates. By the way, that's kind of the binary kind of thing you got to do as a test taker, is say, okay, is this a speculative position or is this a stock position? Because those are different things, different analysis in terms of the road you're going to go down. A customer shorts 100 shares at 143 and buys a 145 call. So there we go. I figured that was going to happen. There's my answer set. Again, you can just do your T here and say, okay, well, I brought in, ooh, that doesn't work. You got to be careful, right? I did bring in 145. I brought in 143. And I paid 4 points for the protection. So ultimately, I could chop my answer set and know that I need an answer that if I plug it in here would make the columns balance, because that's what break even is. Break even is same dollars out as dollars in. So indeed, if I buy the stock back at 139, so I short it at 143, I buy it back at 139. I'm just illustrating that indeed that is the break even. It's the stock 143 minus the option 139. So whenever when you're doing multiple things, it's either going to be buy, or sell, then you're going to combine the numbers. And whenever it's buy, sell, you net the numbers to get the break even, right? So this is a sell and a buy, and so you net to get break even. All right, well, that is our 30 minutes. So let's see, we got to slide 23. So it looks like Dina is not on pace to get this done in a timely fashion. So I'm going to go ahead and you can turn back over my timer and you guys can take a break. And then I'm going to resume. I'm going to continue my march through this. So again, I've reset my timer for 30 minutes. I'm going to continue to march. And I'm trying to bring this in about an hour and a half. So I'm going to have to pick up the pace here a little bit. But remember, you can take as long as you want. You can hit pause. That's what I suggest how you do this. Hit pause, try and come up with your answer, and then hit play and see if you got the right answer and see if my explication makes sense. That's what I would do if I were a test taker. All right, well, as I said, Dina is going to continue on. And so make sure I'm on the right slide. Indeed, I am. So here, what is the maximum gain? So we're still looking. By the way, I try and make my practice final. So I just should tell you, my practice tests are not, like green lights or mastery exams. I'm not designing my practice test to have correlation with how you're going to do on the test. I'm using my practice tests as a teaching tool. So this will go into two playlists. This will go into our practice test playlist and our options playlist. I have now, this will make 5 practice tests, but they're based on debrief. They're based on things I want to share with you. So I wouldn't expect correlation. I have a Test Geek exam up there for Series 7 that has good correlation from my friend Brian Lee. I have done a Kaplan practice final, which has pretty good correlation with the actual exam. So again, if you can make T's and you can track money, you're in pretty good shape. And so again, if what it looks like is foreign to you, you're not understanding the matrix or the T or any of that stuff, I just go back and tell you watch the first 3 videos and the options playlist. So here, I bought 100 shares at the 143. And then I created an obligation to sell at 150. This is called a covered call. I would definitely know this is a covered call. And the disadvantage of a covered call is you don't participate past the strike price. This is an obligation to sell the stock at 150. Now, the difference is I actually own the stock. So as we said, when you buy 100 shares of BFD at 143, this is a bullish position. And so the best case scenario now is it gets called away from me at 150. And so I make 7 points on the stock, 143, 150, plus I make 7 points on the option. So the most I can make is 14 points or $1,400. Now, another way you could do this is you could say, well, I'm net out of pocket. I paid 143 for the stock. I brought in 7 points for the option. So I'm net out of pocket 136, and I have to sell at 150. So that ultimately would be the break even to the strike. So a couple ways to get the maximum gain in a covered call. The main takeaway is to make sure you realize you don't participate past the strike price. I would definitely know, why do we do this? We do this to generate additional income. That's why we do covered calls. A customer buys 1 BFD, December 140 put at 7, when BFD is 141. You cannot be fumbling around. This is about layup. This is about as easy as it's going to get. And put down the break even in puts, long or short, doesn't matter where you buy or sell it, is strike price minus premium, 133. Now I would make an arrow next to my break even to remind myself that I want the stock below that. By the way, if we're short, it's the same break even. It's just a matter of whether we want it to go up or down. So this is a bearish position. And remember, it doesn't matter where it's trading at 141. It matters, where it's at several weeks later or at expiration, whatever the case may be. Again, it doesn't matter whether you're long or short, put down strike price, less premium. I'd make an arrow to remind myself. I just had somebody who was struggling with this idea that you can be short and be a bull. Short doesn't mean bearish all the time, right? If I'm short a put, that is a credit or short position to which I'm bullish. I want the stock to be 140 or higher, so the put expires and I can keep the money. I get to go neener, neener, neener. But ultimately, the break even is the same, strike price less premium. A customer buys 100 shares at 140. This is kind of interesting, and this is just me sharing something with you. So I wouldn't worry too much about this as a test issue, but to be honest with you, we have three versions of a covered call. We have a covered call where we agree to sell at a lower strike price. So kind of odd, huh? I'm buying the stock at 140 and I'm agreeing to sell it at 135. So that contract is going to be 5 plus the time value. So what I'm trying to do is collect the time value. But ultimately, if I do a call in which I'm agreeing to sell at a lower strike, that is a bearish covered call. So we have three versions of a covered call. We have a bearish covered call where we agree to sell at a lower price than we originally paid. We have neutral covered calls and we have bullish covered calls. Don't ever say on the test you can't figure it out. That's never the right answer. You sell one BFD December 140 call and you buy a 150 call at 2. Wow. Okay. So we have to be able to identify this. And so it looks like I'm long and short the same type of contract. So let's see. I brought in 7. That's dollars in. And I paid out 2. So it looks like to me that what I'm looking at here is a credit spread, a 5-point credit spread. Now, if I was going to, I would make my T, and there's 8 things you need to know how to spread. This is, again, just a practice kind of thing. So I'm not actually following the process I normally follow because I'm trying to get this done in timely fashion. But anyways, break even, we're going to use CAL, and that stands for call add to the lower. Call add to the lower. Now, as a test taker, you should definitely know that the break even has to be somewhere between 140 and 150. There's a floor at 140 and there's a ceiling at 150. I have an obligation to sell the stock at 140 and a choice to buy at 150. All the action takes place between the strikes. So you can toss out anything offered to you on the test that isn't somewhere between 140 and 150. Right? It's got to be a number somewhere between. That alone could get you 50-50. So the way we're going to do that is we're going to take the lower strike, which is 140. We're going to add the net premium, which is 5, and we get our break even of 145. P.S. I would know that the larger premium dominates the position, so this is bearish. We'd want the stock to be below 145. By the way, I have, again, advanced option strategies. I also have entire lectures on a spread, 15, 20 minutes, and I have call spreads and put spreads. And so you got plenty of stuff you need to review spreads. So again, this is the same spread. And whenever I collect money, the best case is I keep it, right? So what I hope is that the contracts expire. So here's my 140 call that I brought in 7 for. There is my 150 call that I paid 2 for. And again, what I'm hoping is the contracts expire. And if the contracts expire, that would be wonderful. I make $500. The gain and the loss always equals the difference in the strikes. By the way, this is a credit spread. And so again, I'm not lecturing spreads, but credit, expire, and arrow. A customer buys 100 shares. Well, as we said, when you buy 100 shares at 141 and you sell at 140, you have an obligation to sell at 145. So again, we said this is a cashless caller, and a caller, remember, is when we sell the call to fund the purchase for the put. And so again, I'm just tracking money. And so we paid 141 for the stock. We sold the call to pay for the put. So that's a cashless caller. what is the maximum loss? So I have a ceiling at 145, but I have a floor at 135. Anytime I want, I can sell the stock. I have a choice to sell at 135. So it looks like my worst case is I'm out 144, 138. And so my maximum loss is $600. Again, sometimes you just need the T. This is called a cashless caller. I wouldn't worry about it. Why do I have a couple of these in this practice test? Because people who use vendors will send me questions like this often frequent enough. So this is more about your test prep vendor than it is actually about being able to do this on the test. All right. So again, we're looking at this call contract. And, again, this is a very smart person here, because now I know the worst case is I'm going to buy at 150 and deliver at 140. It's still going to be painful, but if we track the money again here, on the 140 call, we brought in 7, we paid out 2. So now the worst case is we're going to buy the stock at 150 and deliver at 140, which we're obliged to do. So the worst case is I'm going to lose the 10 points there, less the 5 that's already in my account, right? So the most I can lose is 500. Remember, the gain and the loss always equals the difference in the strikes. And so here we have a credit of 5 points. The difference in the strikes is 10 points. And so if that's my gain, then the opposite would be my loss, right? The gain and the loss always equals the difference of the strikes. Here we go again. BFD 140 call at 7 and a December 150 call at 2. At expiration is 200. What is the gain or loss? So again, what I'm trying to show you here, a little more sophisticated perhaps than what you need to do in terms of memory work, right? I've said in terms of memory work, there's 8 things you got to be able to do on a spread. And if you've watched my lectures, you know those 8 things. But here I brought in 7 for the 140 call. And I paid out 2 for the 150 call. And so now the stock is 200. Well, if the stock is 200, thank God, I have a choice to buy at 150. So I'm going to buy the stock at 150, right? That's what's going to happen at expiration. If the contract has intrinsic value, these contracts will be exercised. So I'm going to get exercised. I'm going to buy the stock at 150 and I'm going to get exercised, sell at 140. That's what I'm going to do. Please note, when we net that out, I'm out 152. I brought in 147. Boom. So that's the whole point, by the way, of having the 150 call there. There's a floor at 140 and there's a ceiling. So once it goes past 150, it doesn't matter. It doesn't matter. By the way, even if I said close it out for intrinsic value, let's just show you that. So again, let's just go back. And let's say that I say the stock is 200 instead of saying at expiration. And now I don't say at expiration, I say with the stock at 200, you close out at intrinsic value. Well, the 140 call is going to be 60 and the 150 call is going to be 50. That's the biggest difference there can be. Some people always say, oh man, what's this thing about widen and narrow me? And widen and narrow is about the difference in the premiums. And the worst case is this widens to a difference of 10. It wouldn't matter if I did this again at 210. It would be at 210, it would be 60 and 70. So that's kind of what we're getting at there. Again, a little bit, I'm trying to add some higher end option questions in this practice test for you. You've been doing plain vanilla stuff. So, but the main point is to know that's the point of the spread, right? It's the gain and loss. A 150 put, a 140 put, and a 130 put. So again, this is a put spread. And it looks like I paid 7 for my obligation to, or received 7 for my obligation to buy at 140. And I paid 2. So now worst case is somebody sticks it to me at 140. I can stick it to the next guy at 130. All the action takes place between the strikes. And again, we said this is 10 points. And we said the gain and the loss always equals the difference in the strikes. So I've collected 5 points. That's my credit. That's my gain. And we said the gain and the loss always equals the difference in the strikes. So something plus that, right? There's 10 points to be made or lost, the difference in the strikes. A customer buys one BFD 140 put at 7 when BFD is at 139. It doesn't matter where BFD is at when we do the trade. What is the maximum gain? So when I buy a put, I am bearish. So I paid 7 points to be able to stick it to somebody at 140. What I've established is the choice to sell at 140. When you buy a put, dollars out, you've established the choice to sell, dollars in. And so the best case here is the stock goes to 0. And I get it out of the trash can, and somebody says, you're making me pay 140 for stock that's worthless. I say, absolutely. If you didn't want to do that, you shouldn't have collected the 7 points. So the most I can make is when the stock goes from 140 minus 7, strike price less premium to 0, or break even to 0, or break even. By the way, that's 133, but it's on 100 shares. So again, suggest you do things on a per share basis. And then when you're all done, look at the question. A customer buys a December 140 put at 7. You know, we said 1 of 3 things can happen to an option contract. It can be traded, it can be exercised, or it can expire. So whenever you buy an option, the max loss is your premium, 7 points or $700. And which of the following short option positions, if exercised, would result in the delivery of cash equal to the aggregate exercise price? Right? So if I sell a, what do we just do, a 50 put or 40 put? If I sell that 50 put at 7 and somebody exercises me, I'm going to have to pay $5,000 for the stock. So that's what that means, cash equal to the aggregate exercise price. And that's what you need when you're short a put. You need the cash to pay for the stock. Right? We said in this, you need the stock to make delivery. In which of the following long option positions, if exercised, would deliver the delivery of the underlying? Right? So where do I have to? It's when I stick the stock to somebody. Right? So if I make you buy the stock, I need to have the stock, and you're going to give me the cash. Right? So, you know, you're going to pay for the stock. So you need money and I need the stock. Which of the following long positions would be if exercise delivery of cash equal to the exercise price? Well, that would be the long call, right? Because you need to pay for the stock. So if you exercise the 50 call, you need $5,000. So, you know, here we just, let's just get this whole answer set done. And then remember, if there's exercise, you have T plus 2. So the option contracts are T plus 1, resulting stock exercise is T plus 2. A customer shorts a BFD 140 call at 7 when BFD is at 141. You should definitely know that when you sell option contracts, the best case is you agree to be a potential victim. Nobody victimizes you, and you keep the money. So the best case here is you got 7 points, contract expires, and you keep the money. A customer shorts a 140 call. Boy, this is a guaranteed test question. This is a guaranteed test question. You should definitely know that if you agree to sell stock you don't own, that is a naked or uncovered call. And naked or uncovered calls have unlimited loss potential. Unlimited loss potential. That's just really foolish. We talked about dumb bears. Maybe you should consider a covered call or a credit call spread or something smarter than this. A customer shorts a 140 put. Again, you shouldn't be struggling with the idea that if you sell an option contract, you agree to be a potential victim. Nobody victimizes you. Contract expires, and you get to go neener, neener, neener. You keep the money, 7 points or $700. A customer buys BFD at 140, and now we're agreeing to sell it at a higher price. So we said there's 3 versions of a covered call. And so this is going to be a bullish covered call because you're agreeing to sell at a higher strike than what you bought the stock at. Now, the more bullish I am, the higher the strike I'm going to write. The less bullish I am, the lower strike I'm going to write. Which of the following may be used as an alternative to a buy limit order? So if you want to get the stock at less than the current market price, one way you can do is enter a buy limit and tell your broker if it trades at, if I can get it for my price or less, as a buyer, my price or less, please do so. But you know, when you short a put, you're getting paid to buy the stock, right? So if it's a 50 put and I get 3 and I get exercised, I paid 47 to the stock. So if I'm your registered option principal, I say, what does the guy want to be approved to do? You said, Dean, he wants to be able to short puts on stocks he wants to buy. He wants to agree to buy stock, and then if somebody sticks it to him, he's going to say, thank you very much. I wanted the stock anyways. You know, Mr. Buffett likes selling puts. He's been buying Occidental Petroleum. And if he wants to buy more Occidental Petroleum, why not write the puts? And worst case is they expire worthless. And if he gets exercised, well, hey, neener, I wanted the stock anyway. So one reason to sell an option contract is to get paid to do something you're already prepared to do. This is a put spread. This is a put spread. And so our mnemonic for a put spread is push. That stands for put subtract from the higher. So we're going to take the higher strike, which is 140. We're going to minus the premium, which is 5, and we're going to get our break even of 130. Oh, let's see. Does Dean, looks like, again, I got a little bit of a typo here. So let's see. This is slide 44. So slide 20 and slide 44 have issues. So we're going to take the higher strike, 140, and we're going to subtract the net premium. So the break even is 135. So it looks like I got a problem with that slide. No, there. So what are we going to call that? We'll call this choice E for error. A customer buys 100 shares at 140. So again, it's a covered call, but you're agreeing to sell it at the same price that you bought it for. And that would be a neutral covered call, a neutral covered call. A customer short 100 shares of XYZ at 87. And which of the following would be a suitable recommendation? And, you know, we have options. Some people aren't approved for options, right? So if you're not approved for options, maybe you say, well, Dean, I'm not approved to, you know, buy a call. So we enter a buy stop order. So, you know, these are called option order equivalents. You know, we have 2 arrows in our quiver. Sometimes we can use an option contract to accomplish something, and sometimes we can use a type of order to accomplish something. Your client is a U.S. exporter. EPIC stands for exporters buy puts and importers buy calls. So if I'm a U.S. exporter, I'm going to buy a put on the foreign currency. Now, again, you can think about it after you get the right answer, but if I'm Boeing and I'm selling my airplanes in Japan, you know, what I'm afraid of is the yen is weak and doesn't buy me as many dollars. So I'm going to buy a put on the yen. By the way, you can get a 50-50 here because the US dollar, I'm not being facetious, is not a foreign currency. So that's never going to be the appropriate answer to do anything with the US dollar. There's an inverse relationship with currencies. What is the maximum gain? So again, we've collected $500. Whenever we collect money, the best case is we keep it. So we sold it for 7. We brought in 2. So this is a $500 credit spread. We're hoping the stock is 140 or higher, puts expire, and I keep the money. A customer is short a January 70 put and long a BFD January 60 put. The higher strike puts are always going to have a greater premium. So higher strike puts always have greater premium. So that 70 put that I'm selling is going to bring in more money than I'm paying. And so this is a credit put spread, and a credit put spread is bullish. Now, this is in this practice says because people tell me that they get asked to identify the spread with missing premiums. And I know you're not surprised. I have a whole lecture on this. So if you go to the options playlist, you'll say, what type of spread is it? And again, it's just a whole 20, 30 minutes on determining spreads missing premiums. So this is a credit put spread, which, by the way, remember, short a put is bullish. So when is the option agreement completed? So, listen, when I give you the OCC disclosure document, there's no way you can read that while I wait. And so I say, listen, here's all the bad things that can happen to you, the OCC disclosure document. I'm going to go back and try and get you approved. So my registered option principal approves you, and I call you. I say, hey, good news, you're approved. I need back from you the option agreement within 15 days of the account approval. So we have this window where you can be trading. Now, if you're late, then all you're going to be able to do is closing transactions. An investor is bearish on the stock. So bearish on the stock means she thinks it's going down. She wishes to invest in such a way she's exposed to limited risk. So this is out, right? Limited risk and has the lowest margin call. Well, that means this is out. Because if you short the stock, you're going to have to come up with 50%. So now this goes out. Short a call goes out because that's unlimited risk. Boom, by process of elimination, we're going to tell her she should buy a put, pay the premium. I was in this chat room where everybody was raging bulls. And I said, are there any bears in the woods? I said, listen, I'm bearish and I'm going to take a bearish position in the stock. Listen, we need to do battle with these people intellectually and tell them why they're wrong. And somebody shows up and says, hey, Dean, I'm a bear. And what have you done? I said, well, I haven't done anything yet. And she said, well, I sold the 40 calls naked. I go, oh my God, I'm certainly not going to do that. What I bought was the 40 puts for 4. I bought the 40 puts for 4. I have a choice to sell at 40. I'm going to have to be right about 3 things. Direction, I'm choosing down. How far down? At least 4 points between now and expiration. But if I'm wrong, the stock is 40 or higher. And, I just lose, in this case, $4,000. So as long as that's my play money, not a problem, right? So, that's a very smart bear when you buy a put. Of all the bears in the woods, that's a smart bear, because if I'm wrong, I just lose my premium. A customer buys 1,000 shares of Apple at 139 and writes 10 leaves. Ooh, we're going to get some big bucks from that. 150 calls at 17. What is the break even? So again, you can just memorize. But if you don't want to memorize things, you could get good at the T. Some people like to use pluses or minuses, whatever floats your boat. But, here I paid one. By the way, don't put $139,000 in there. That would be a mess. I recommend you do things on a per share basis. Now I can shop my answer set. And I know that the break even is the number that would make the columns balance. That's what I'm trying to do. I'm trying to do something that will make the columns balance. That doesn't make it balance. So you can either memorize it. That doesn't make it balance. That doesn't make it balance. Ding, 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 ding. So this is the one time and the one time only that we actually have a call contract. And its stock costs less premium. We're minusing to get the break even because, again, this is not an option position. This is a stock position. And God forbid you don't know that's a bullish stock position, because otherwise you're going to tell me, oh, the break even is 150 plus 17, 167, unlimited loss, bearish. No. Stock positions dominate. Which of the following is used? I always put this in every options practice exam. So when you hear eliminate or reduce, it's going to be a closing transaction. And so, if I did this, an opening sale, the way I get out of that is to do a closing purchase. All right, well, there we go. That's 1 hour in, and I'm about halfway through this practice exam, this practice test. Let me reset my egg timer. And again, you may want to take a break. As I said, you can knock this out in little chunks if you'd like. I don't know how many of you have been following me for a while or been one of my viewers. If so, thank you so much. I really have expanded the studio. So I've taken over, an entire place for my studio. So I don't know. Let me know what you think about the new digs. I'm not quite done. I've got some more work to do here, but it's operational enough to start doing some content again. So anyways, let me know your thoughts, and I'm going to continue to march on. So take your break, rejoin me, and we'll continue to march here. A customer is short BFD December 140 call at 7. when BFD is 141. It doesn't matter. At expiration, you close the position. So again, I'm trying to get you more comfortable with this idea of what can happen to option contracts. You know, this option contract can be traded, it can be exercised, or it can expire. Now, at expiration, this is a 140 call. It's a 140 call, and the stock is 154. And so that means I'm going to have to go into the open market and buy the stock at 154 and deliver it at 140. And again, I lose 7 points. Now, again, you could just memorize your break evens. Strike price plus premium, 147. I'm bearish, 154, 7 points in the wrong direction. But I see a lot of people memorize break evens, but then they get test phraseology and they can't, figure out what they're being asked. And so here, as you can see, we have a $700 loss. Now, remember, that could have been a lot worser, right? Worser. Because, whatever, I don't have the stock. So, this could have been 160, 170, whatever the case may be. A customer is long 1 BFD 140 call. All the following are which of the following. Adding which of the following to the position would create a debit spread. So a debit spread, remember, would be debit call spread is when I have more money out than in. And you should definitely know that lower strike call contracts always have greater premiums. So, what I'm going to do is sell the higher strike call to lower my out-of-pocket cost on the 140 call. Boom. So that would be a debit call spread, by the way, which is bullish. So again, I put this in there because people have told me they, on the test, struggled to identify it. Again, as I have a whole separate lecture on this, but you should definitely know that lower strike calls always have greater premiums. So debit means I'm going to have more money out than in. And so that means it's going to be the 140 dominant leg. And I'm just selling the 150s, not testable to pay for the 140s, lower my out-of-pocket cost. Which of the following would create a credit spread? So now it's going to be the opposite, right? So to create a credit spread, I'm going to have to sell a lower strike call. A lower strike call. So now that's going to be a credit call spread, which is bearish, right? So again, people on the test have told me they've had to kind of do what I'm doing with you now. So as I told you, my practice questions aren't about mastery or green lights or things like that. It's my way of sharing what test takers are telling me and then sharing with you. So you'll be prepared when you encounter questions like this. Customer is long of 140 puts. So you should definitely know that higher strike puts have greater premiums. So if I'm going to create a credit spread, I'm going to have to sell a higher strike put. Right. So that's what it would create the credit, is by selling the higher strike. By the way, again, not testable, but I'm a smart guy. If I sell the 150s, I want to be able to have, if somebody sticks it to me 150, be able to stick it to the next guy 140. I'm still a loser, 10 points, less whatever, the net credit is. So that's D. Adding which of the following would create a debit spread. So now I'm going to have to short the lower strike put, right? Because the debit would be more money out than in. Higher strike puts have greater premiums. And so now I'm going to short the lower strike put, which is boom. And that would be a debit put spread, which is bearish. A customer short 100 shares of XYZ at 87. XYZ is now 62. Which of the following would be a suitable recommendation to protect the profit? As we said last time we saw this, it was a buy stop. But now what we could do is buy a call. Establish a choice to buy back the borrowed stock at maybe 65. And then we would have locked in that profit that we have there. So we go long the call. Remember, if I've shorted the stock, I'm looking for the offset. I need to be able to buy the stock, right? Customer buys 100 shares of BFD call contracts always have greater premiums. And so the lower strike call in a call spread is always going to be the dominant leg, which in this case is short the call, which is bearish. So this is a bearish position. And again, I'm going to get more money for the 60 than I paid. And so this is a bearish credit spread. I've got probably more of these. By the way, you're only getting 20 option questions. I got 100 in this practice test. So again, we're trying to overkill it. sometimes I don't know if that feeds fear or helps you. I have in my playlist for the 65 and 66, 50 math questions, even though maybe you get one or two, but people are so fearful of it that, we try and overkill it a little bit. All the following can happen to an option contract except the option contract can be traded. So you did an opening sale, you can do a closing purchase. If you did an opening purchase, you can do a closing sale. That's correct. The option contract can be exercised. Yes. Remember, equity options are American style, so you can exercise anytime you'd like. You don't have to wait till expiration if you don't want to. That's one of the risks if you're short. Don't tell anybody, but I didn't have 20 grand to buy 1,000 shares at 20. And I knew I was going to have 20 grand, but I didn't have it right at that second. I was afraid by the time I got the 20 grand, the stock would move away from me. And so I bought the 20 calls for 10 of them. That's $2,000. And then I wasn't waiting around for expiration because I wanted the stock. It's part of one of my core holdings at the time. And so I exercised early. I'm entitled to do that. The contract can expire. A good way to remember it is T. The option contract may break even. No, options contracts don't break even. Players do. So be careful when you're being asked about, the player. This is a good what I call a poor man's flashcard. If you've joined me before, you know what a poor man flashcard is where you get rid of the except, and now you know what you need to know on the test. And then remember, I told you the other thing that you need to know is if at expiration it has intrinsic value, the contract will expire worthless. Listen, if you were a broker for me and you're trading options, I'd make you write 1,000 times. Options are a wasting asset. Time value erodes. At expiration, the contract is only worth its intrinsic value. If at expiration the contract has intrinsic value, the contract will be exercised. If at expiration the contract has no intrinsic value, the contract will expire worthless. 999 more times. If at expiration an option contract has intrinsic value, options are a wasting asset. If it has intrinsic value, the contract will be exercised. It has no intrinsic value, it will expire worthless. A customer buys 100 shares of DD at 74 and buys a DD 70 put at 3. What is the customer's cost base? For the most part, cost base follows break even. So people really get hung up on taxes in a way that I think is way beyond what you're going to need to pass your 7. But I paid 74 for the stock. I paid 3 points for the protection. So cost basis is 77. This is a protective put. There are exceptions to what I just said, but for the most part, if you get asked cost basis on the exam and you do the break even, for the most part, you're going to be correct. For the most part, you're going to be correct. An American manufacturer is exporting to Canada. Again, you don't need to know the why, but remember, we can get rid of anything on the dollar. Here, I don't have anything on the dollar. So, I have all the 4 basics. So remember, if I'm an American manufacturer selling to Canada, I'm worried about the Canadian currency going down. And so what I'm going to do is buy puts on the Canadian dollar. Let me know your thoughts. I've been thinking about doing kind of something similar that I'm doing now. And maybe just really overkilling non-equity options. Maybe doing 20, 25, 30 questions on non-equity options and put that as a practice test into the playlist. Again, you're not going to get anywhere near that many, but maybe we exhaust the potential questions. You definitely need to know has limited risk and unlimited gain. Limited risk and unlimited gain, that would be a long call, right? And then a short call you should know is the opposite, which sounds kind of silly, right? The short call would be limited reward, limited gain, and unlimited risk. By the way, in the long put, you don't have unlimited, right? It's just a 0. A customer is long an Apple December 140 call at 13 and short a December 155 call at 6. What is the maximum gain and maximum loss? Well, we said the gain and the loss equals the difference in the strikes. There's 15 points to be made or lost. All the action takes place between the strikes. And so here I'm out 13, I brought in 6. So this is a 7-point debit spread. This is a 7-point debit spread, right? the difference between 13 and 6, which is 7. And so it looks like my loss is what I paid, and my gain is when I buy the Apple at 140 and I sell at 155, I make 15 points, right? So 8 and 7, the gain and loss always equals the difference in the strikes. So here I paid out 7, and I can make 15, which leaves me with 8, right? If I buy the Apple at 140, which I have a choice to do, and I sell at 155, which I'm obliged to do, that's 15 points. I spend 7 to get going. I make 8. By the way, if you don't get that, if you don't get that, then you got to memorize the maximum gain in a debit spread is the difference in the strikes less than net debit. I just think that's a mental mess. But however you get there, and you need to get there. A customer buys a December 120 call at 12 and exercises. For I told you, for the most part, cost basis follows break even. So 132. 132. A customer is short an Apple December 140 call at 13. At expiration, what price or prices will the customer make his maximum gain? So for me to make a maximum gain, I have to have the stock price be below the strike price. So boom, right? If at expiration, Apple's below 140, I could have actually said 140 or below, right? Because the contracts expire. All the following expose a customer to unlimited risk except. So again, the only effective hedge here is this one, right? Here I'm exposed, and here, remember we said the whole point there is that doesn't effectively hedge the position. So if you want to effectively hedge, by the way, a long call and a short stock position is so smart because it changes the position from unlimited risk to limited risk. The Options Clearing Corporation assigns exercise notices to broker dealers, very testable, randomly. Boy, you can't be giving up recognition questions. You know, the 3 styles of questions you get on Series 7 are recognition, practical application, you know, like what is the break even, what's the max gain, max loss, and judgment. You know, save your misses for judgment. About 10% of the questions are judgment. Those are the hard ones. Those are like suitability questions, for example. A customer is long 10 Apple, December 155 calls at 4, and short 10 Apple 140 calls at 13. Now, this is the dominant leg. Remember, the larger premium dominates, and lower strike calls always have greater premiums. That is the dominant leg. But boy, is this guy a smart bear. Because if he just did the naked calls, his break even would be 153 and he'd have unlimited loss potential. But now if it blows up, he can buy at 155. The gain and the loss equals the difference in the strikes. And so of that difference, he's already collected 9 points. That's his gain. That's the credit. And that's the max gain. And remember, the gain and the loss always equals the difference in the strikes. And that's why credit call spreads are just so bueno, so cool. Now that's 6 points, though, remember, on 10 contracts governing 100 shares. So again, I do things on a per share basis. Then when I'm all done, I look at that. Ooh, this is a long one. An investor is long 1,000 shares of Tesla at 386 a share. Tesla is now trading at 781. If the investor wants to be able to participate in a big price increase, but not participate in a big price decline, which of the following would be most suitable? And we said a protective put would fit the bill there, right? I established the choice to sell the Tesla at the strike price, whatever that strike price is. I pay a premium for some insurance. I have a whole lecture on protective puts. An investor is long 100 shares of Apple. Apple does pay a dividend. But the investor would like to supplement that dividend with additional income. On the test, when you see income, you know you're selling an option, right? And that's the whole point of a covered call, is to generate additional income, right? So that's what you're going to do there. Now, I'm being kind of a jerk because I didn't give you any. Usually on the test, you'd have a 50-50 because you'd have 2 choices that say buy and 2 choices that they say sell. A customer is short 100 shares at XYZ at 87. XYZ is now 62. Which of the following will be a suitable recommendation to protect the profit? So, you know, when we do hedges, sometimes it's to stop a loss, but other times it's to protect a profit. You should know that I need the offset, right? So if I've sold the stock, the offset is to be able to buy the stock, right? So I should be able to get rid of this because I don't want to do that, right? That's a choice to sell. I've already sold the stock, so I don't need to do that. An obligation to buy. No, I don't want an obligation. I want to have a choice to buy back the borrowed stock. This would be an obligation to sell, and I've already done that. So the answer is C. A customer is long 100 shares of BFD. Oh, it's now 123. We're long this time. So 123 is bueno. So which of the following would be a suitable recommendation? I buy a put. You know, I can't tell you how many times I would be so aggravated as a broker when, you know, I'd be trying to get somebody to marry a put, MRRY, marry a put to their stock position, particularly when we have a paper profit. I'd say, you know, why don't we buy, like in this example, a 120 put, you know, for 4. I'm just making up the 4, but, you know, and then I'd have a customer say, well, gee, Dean, if it's 120 or higher, the put expires and we wasted our money. I said, well, listen, we're not buying the put in case we're right. We're buying the put in case it moves against us, starts going back down again. There's no sense going back the opposite direction. An investor is contemplating entering a buy limit. Which of the following recommendations may be suitable as an alternative to the buy limit? We said, why not get paid to do something you're already prepared to do? So if you say, Dean, the stock's at 50 and you're going to put in a buy limit at 48, I say, so you're telling me you can buy it at 48 or less, you want to do so. You say, yeah. I said, well, nobody has to sell it to you for 48 or less. And you say, well, gee, Dean, you're kind of rude. I said, well, I'm just letting you know how this thing works. And I said, you say you want to buy it at 48, but if it goes, you buy it at 48, it goes to 0, you're going to lose $4,800. He goes, man, Dean, you know, I don't know where you're going with this. I said, well, listen, I'm just looking at the 50 puts. The 50 puts are 3. So somebody will give you $300 to buy the stock at 50. And that means you're effectively paying 47 for the stock. So again, one reason people short puts or sell puts is an alternative to a buy limit order. A customer is long 100 shares of XYZ at 87. BFD is now 123 a share. Which of the following would be a suitable recommendation? And again, what we're doing is contrasting the options with the stock positions. Whoop. Dean's not paying attention here. I don't need a buy stop. I need a sell stop. So sell stops can be used to, again, all stop orders can be used. Stop orders can be used to stop losses. That's the number one use of a stop order. That's why they're called stop losses, stop the bleeding. They can be used to protect a profit, a sell stop to protect a profit in a long position, and a buy stop to protect a profit in a short position. And they can also be used to establish stock positions. So the answer here is C. Your client is a U.S. importer. Again, you should be able to get rid of this, and you should be able to get rid of this. I'm not being facetious. The US dollar is not a foreign currency. So if I'm a US importer, I'm going to be worried that my dollar is weak, right? So if I'm importing European wine, for example, I'm not worried my dollars are strong. I get more wine. I'm worried about the dollar is weak. And so what I'm going to do, remember, EPIC, exporters buy puts, importers buy calls. A customer buys a December 120 call and exercises. We said for the most part, cost base follows break even. 132. An investor is contemplating entering a buy limit order. Which of the following recommendations? I think I accidentally put a duplicate slide there. So I put this answer set. This answer set is there. You've got to be comfortable with this answer set. And so we did an opening purchase of the option. If we did an opening purchase, dollars out, the offset of that is going to be dollars in. We do a closing sale. Or we said the option can be traded, the option can be exercised, the option can expire. Option position limits apply to the same side of the market. What is the bearish or sell side? And so we don't want the options wagging the dog, the tail wagging the dog. So here it says bearish. That would be the bullish side of the options market, long calls and short puts. A long call is a choice to buy the stock. A short put is an obligation to buy the stock. But this says the bearish side of the market. And so the bearish side of the market is going to be an obligation to sell the stock and a choice to sell the stock. So it's going to be long, short calls and long puts. Now, I would memorize position limits because on the test, they'll say assuming position limits are. Assuming position limits are. Now, I don't know if I made another slide here. Maybe I did, maybe I didn't. But remember, if this would have said the bullish side of the market, that would be long calls and short puts. If I said bullish side. This one said bearish. And the other word they might say is sell side. And for bullish, they might say buy side. Now, we don't mean buy or sell the options. We mean buy or sell in relationship to the stock. So the answer to this one is D. Customers long a March 150 put and short a 135 put. This can best be described. Well, remember, higher strike puts always have greater premiums. And so that's going to be the dominant leg. So my dominant leg is a long put, which is bearish. So I know it's either this one or this one. And I'm going to pay more for the 150 than I'm going to bring in for the 135. And so this is going to be a debit put spread. Now, I added way more of these questions in this practice test than you're actually going to see on the actual exam because people tell me, that they've encountered this. A customer short 100 shares of BFD at 40. What gives the customer the best protection? So when protection, we know it's going to be buy. Particularly if it says best protection. We don't want a partial hedge. We don't want something that kind of works. Go through my hedges, how to hedge. And I have some, kind of some neat graphics on some of those lectures. But anyways, here, if I'm short the stock, I want to have a choice to buy back the stock. So the answer is C. C. By the way, you should have immediately been able to get rid of this, right? And then you got to know the offset. Customers long a 150 call and short a 135 call. We should know that lower strike call contracts always have greater premiums. So the dominant leg in the spread, those are called legs, not testable, but the dominant leg is being short a call, which is bearish. And I'm going to receive more for the 135 than the 150. This is going to be a credit call spread. Very testable. We said if you're interested in generating additional income on a stock, you're going to do a covered call. You could expect 3, 4, 5 covered call questions on your exam. So, make sure you got the covered call down. A customer buys 100 shares of BFD at 46.90 and writes a BFD 50 call with a premium of 150. So let's see. I paid 46.90. I brought in 150, 1.5, and the call is exercised. So it looks like 5150 versus 4690. Let's see. So it looks like I have a gain of 460. There's nothing in the question that says it's long term, and so it's going to be a short term gain of $460. Leap are typically issued. They're technically 39 months, but in practice, they're 3 years. I would expect this. By the way, this is the only option position that you can qualify, perhaps, because you have to be long. But remember, to qualify for a long-term capital gain, you have to be at risk for more than 12 months, and this is the only option contract that you could be long and be at risk for more than 12 months. So people have seen this on the exam, so be prepared for a question about a leap. As I said, they're technically 39 months, but typically 3 years. The key point, though, is the point about more than a year, right? That's a good poor man's flashcard. A customer is long a BFD October 140 call. A diagonal spread is when both the strike price and the month are different. So we need to have a different month. And we need to have a different strike to be a diagonal spread. Now, I think somewhere in my lectures, what type of spread, I show you why it's called a diagonal, vertical, or horizontal based on the what's called the option chain. So you might want to check that out. I think when you see it visually on a display, a quote screen, I think it makes a lot more sense why we call them these types of spreads. Low probability, but people have seen they've seen it. All following subject an investor to unlimited risk. Again, you have to recognize the effective hedge, which is D, right? This is the effective hedge on a short stock position. Again, the higher strike put is the dominant leg. So the dominant leg is the one with the greater premium. That's always going to be the higher strike put. Shorter put is bullish. So I have a 50-50. And I'm going to bring in more for the 150s and I pay for the 135s. And so this is a credit put spread and is bullish. A customer buys 1,000 shares of Apple at 139 and writes the 150 calls at 17. The max gain is when I deliver the stock at the strike price. And so the difference between those, again, I would do this per share, but that's 167N minus 139. And that's 28 points on 1,000 shares is $28,000. Use your calculator. I mean, my arithmetic is terrible, so make sure you use your calculator. The S&P is trading at 1864 and 1850 call. So 1850 is the strike, and we'll put this in a different color here. It's trading at 1864. The option contract is out of the money. Now, this is a call contract, and the market price is up. So it's not out of the money. The option contract has intrinsic value of 14. Let's see, it's 1850, 1864. It has intrinsic value of 14. That's true. That is true. But time value of 4, that's not true. The option contract is, oh, I'm sorry, they gave us the 18. I didn't see that. So again, having a process is important. So the premium is 18, and the premium always equals the intrinsic value plus the time value. So we said the intrinsic value is indeed 14. And so that means the time value is 4. And so the answer is boom. I would expect a question on index options. I would know index options, the exercise is in cash. So assuming I'm short, I don't know if I'm long or short here, but let's assume I'm short. At expiration, I'm going to deliver the cash value of the intrinsic value. And I would know, unlike option equity options, the contract and the exercise are both T+1. 50 call and a 50 put, that is, looks like a short straddle, and it looks like 5 points. And so at expiration, remember silo, if we're short, we want it in between these two numbers. So my break even is 55 and 45. So I need it either below, it looks like, yeah, below 55, above 45. Sometimes I'm so clever, I actually trick myself. Hey, well, listen, it looks like I'm at 90 minutes. I think my goal was, again, I'm going pretty quick. But again, you can always stop. And remember, you can pause and go whatever pace you'd like. But what I said is I want to make sure that, I get these done in some kind of a timely fashion. So I think that's my 90-minute mark, I think. So I told you I'm one of the few people, the only person I know. When I started the YouTube channel, like, oh God, 18 months ago. People told me long form content doesn't work on YouTube, but I'm more of a guy who likes to lecture and spend some time with you. So anyways, that's going to be inside, right? I need it below 45 in between the market price of the stock. Almost done. The S&P 500 and index, there we go. So this is very testable. Is 1864. Which of the following is true of the writer of the 1850 call? The writer must deliver 100 shares of each of the stocks. Oh my God, if that were true, nobody would play. If what that was, if true, and you had to actually deliver the stocks on the index, nobody would ever write an option contract with you. The writer must deliver 1,400 in cash. That's true. That is true. On T+2, that is not true. Now, any part of a statement that's false makes the whole statement false. So A is false, B is false. The writer must deliver 1,400 cash to the holder on T+1. There we go. Ding, 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 ding. That is very testable to know that index options settle in cash and to know it's T+1. That is very much a test question. A customer received the OCC disclosure document, was approved, and did their first trade. How many days from account approval do you have to return the option agreement? We've seen this a couple times, 15 days. The option clearing, we said, does it randomly. The firm can do it random, FIFO, or another fair method. So I would know the OCC does it randomly, and I would know the broker-dealer can do it random, FIFO, or another fair method. You can't be given up. This is a layup. It's break-even's 147. Can't be given that up. Customer is long, a 140 call. A horizontal spread is also known as a time or a calendar spread. And so what I need is the same strike with a different month. So I need the same strike, different month. There we go. Boom. Oh, no, I'm sorry. My bad. I need the same horizontal. I need the same month, but different strikes. So my bad. So it's going to be long at 140 call and short the October 140 call. There we go. Ooh. Horizontal spread is a time or calendar spread. I don't like this because I'm creating a diagonal. No, that's right. December 140. There we go. That's the horizontal or time or calendar spread. Woohoo! Woohoo! So thank you so much for making this 90-minute plus journey with me. Let me know what your thoughts are, what works for you on the channel, what doesn't work for you on the channel, and we will meet again for some more content. You probably will have matriculated by then. Most of the people, who come into the channel and to my life join me for a reason or a season. A reason and or a season. The reason is to pass their exams, and the season is how long it takes them to matriculate through that. So, people usually join us for their first leg of their testing journey, their SIE, and then the second leg of their testing journey, 6 or 7 top off, and then the final leg of their testing journey, which is 63, 65, or 66. If you're on the 7th leg of the journey, please refer people to the channel. We love referrals, and if we can contribute to your testing victory, please send those people who are down the mountain, so to speak, and at base camp getting ready to climb their testing mountain, that you'd let them know about the resources here at the channel. Oh, that was the wrong one. I will see you next time. Remember, inch by inch. Your Series 7 is a cinch, yard by yard. Series 7 is hard.